All right. Thank you very much for joining us today for Drake Talks on U.S. market entry for fast-growing startups. Quick shout out to our Drakestar team, Sasha, Jen, and Daniel for putting together this webinar, and Kate on the L2 Counsel team. My name is Vitaly Golomb. In September, I joined Drakestar as a partner in San Francisco Silicon Valley office, and I primarily focus on the transportation, mobility, and new energy sector. But we are quite a big firm, and I'm a technology venture specialist with a wide variety of experience on all sides of the table. Before joining Drakestar, I founded GS Capital and served as a founding partner at HP Tech Ventures, the corporate venture arm of Silicon Valley's original startup. Prior to going to the dark side, I founded the venture-backed e-commerce SaaS platform Keen and built an award-winning digital agency. My bestseller Accelerate Startup is also used by a number of accelerators and business schools as a textbook. Available on Amazon, Audible, and iBooks. Here's a quick plug. So Louis, over to you.
Thanks again to the teams for putting all this together, and especially to our fabulous panelists, who I will let introduce themselves. But as always, I am lucky and grateful to have you as a partner, Vitaly. I'm just a humble lawyer from the Silicon Valley who helps companies get formed, financed, and scaled for growth. And I spent a lot of time helping companies map through liquidity strategies. And recently, as Vitaly and I were thinking about our next production and how we were going to get people together in this time of social distancing, we thought about a topic near and dear to both of our hearts. How do foreign founders access the Silicon Valley markets, and how do we bring Silicon Valley everywhere, especially when we can't travel? So without further ado, really proud to have this group of rock star panelists, and I'll start with you, SC, who I met a few years ago and who knocked my socks off, and who I begged to not only be my client but also to be an investor, and it's really a pleasure to have you on. SC, why don't you introduce yourself?
Actually, let's hit pause because we do have introductions in a couple of slides. So we'll jump right back in a second. But first of all, wanted to introduce our firms real quick, and we'll come back to all of the content in the agenda. So Drakestar is a large tech-focused M&A advisory firm. We have 27 senior partners, a team of over 100. Focused specifically on technology, media, and communications, and we've done over 370 transactions in the history of the firm. Number one in cross-border mid-cap transactions. So this is a topic near and dear to the whole firm, with over 70% of deals being done cross-border between 6 countries and 9 offices. My mobility team is over 20 of our 100 plus, and we focus on new energy, which is a hot topic, and EVs and mobility as a service. Louis, maybe you could do a quick, more detailed intro on the firm as well.
Sure, I'll be very quick, as I'm sure people are more interested in the panelists than me, but I'm operating an elite boutique law firm in the Silicon Valley designed to fill a gap in the market where we saw that founders needed more legal expertise and time than is possible to achieve with the existing resources in terms of cost. And so we are trying to fill that gap with really practical strategies and solutions that make sense, technology-enabled solutions wherever we can, and human beings all the time. We've represented over 200 companies with over $80 billion raised. We work on both sides of the table, both with founders and with investors. And our thesis is that technology has no borders. And so we want to be there when you're thinking about your idea in the garage and when you're bringing it to the global stage. And today, obviously, if you're trying to come into the US. We spend a lot of our time helping our clients in their day-to-day navigating the minefield of their startups, from how much to juice a new co-founder, to how to think about your cap table, to how to onboard an employee, and on and on and on. Where people pay us money is when it's time to raise money in some sort of a financing, whether it's angel, seed, or venture capital, and obviously when it's time for liquidity. So we've got a great team of multidisciplinary lawyers to help make that happen, and more importantly, a deep network of friends like the folks on this panel. And so with that, maybe that's a nice transition, Vitaly.
Indeed. So why don't I do quick introductions, and then maybe in the interest of time, everybody can add maybe something that I've missed. And then the way we've set up the agenda is we'll do a detailed Q&A with the panelists in the second half. In the first half, we wanted to talk about, first of all, kind of where we are with this year and what the trends are in investment and cross-border investment, as well as kind of the strategy and tactics of how these flips to US happen with companies. So Becky Flint is a product and tech executive based in Silicon Valley. She has built and scaled product and engineering teams globally for both startups and Fortune 500 companies. Currently, Becky is the founder and CEO of dragonboat.io, a revolutionary product portfolio platform for leaders to align strategies and resources to deliver both near-term results and long-term vision. Prior to founding Dragonboat, Becky has held various executive roles at Feedzai, BigCommerce, Shutterfly, and PayPal. SC, who we briefly already heard from, is the managing partner at Mighty Capital and Products That Count, a global community of product managers, leaders, and founders. Previously, she's built products that billions of people use at Facebook, Nokia, and Electronic Arts. And Eugene Malobrodsky is a partner at One Way Ventures, a seed stage VC fund that backs exceptional immigrant tech founders. Prior to One Way Ventures, he founded 2 successful startups. His latest venture was Anchor-Free and its leading product, Hotspot Shield, revolutionizing consumer privacy and security for millions of users globally. In 2018, Anchor-Free was acquired by a private equity fund, WonderCo, where Eugene continued his involvement as chief strategy officer. Eugene acts as a board member for Zero Cognitive Systems and GeoZilla. So let me know if I missed anything. Otherwise, we want to dive right in. We have a lot of slides to get through and a lot of content. So with that, just real quick again, a little bit of housekeeping. We will make slides and video available after the webinar, so don't worry about taking screenshots or notes. We will leave some time for Q&A at the end, so please think of your questions and use the Q&A function in Zoom, which is quite convenient. And with that, we're going to take a deep dive to look at the VC market of 2020. This has been quite an interesting year, surprising in many ways, and as well as a trajectory for 2021. So VC market 2020. VC deal making remains extremely resilient through the pandemic, which was a big surprise. We were all very nervous in March. Overall deal counts are in line with recent years. There is, however, a slowdown at the earliest stages and an acceleration at the late stage in 2020 on the back of large deals, mega deals of 100 million plus in general. So that's kind of a quick chart on what we've seen so far, and it's been somewhat surprising in a positive way. 223 deals of 100 million and above have closed through the first 9 months of 2020, putting the year on pace to set a new record for VC mega deal count. That's just about 1 mega deal per day of the year, if you're keeping track. This move towards larger deals has been in motion for the past 5 years, but the advent of the pandemic has accelerated this trend as uncertainty and desire to support stronger portfolio companies likely drove a flight to quality for investors. Reopening of the IPO window for large tech companies is driving massive rebound for VC exit market. Exits are good, and exits were the hardest hit segment of the VC ecosystem over the first 6 months of the year, but that changed in Q3. The public listings of Snowflake, Palantir, Asana, and Unity pushed exit value to the second highest quarterly total of almost 4 billion, with those 4 IPOs making almost 65% of the total exit value. There were a total of 13 billion plus valuation IPOs in Q3, which is more than the total number of VC-backed IPOs in Q1 of this year. So
Vitaly, does this statistic capture all the SPACs, those special purpose acquisition vehicles that take a private operating company and flip it into public status cheaply and quickly?
I don't believe these numbers cover the SPACs, because those are technically well, they're not VC backed IPOs per se. They're kind of more of an M&A deal. So there are a number of other multi-billion-dollar IPOs, direct listings, SPAC combinations that the markets are expecting from VC-backed companies.
Yeah.
While the IPO windows remains open, and we'll see how first half of next year fares as far as SPACs go. By the way, we are planning a SPAC-focused Drake talk probably in December. And it is no surprise, large funds see continued success, pushing 2020 total fundraising value higher than 2019. Through Q3, US VC firms have raised 56.6 billion across 228 funds, exceeding 2019 total fundraising value of 54.9 billion. So surprisingly, this year again has been quite good for the venture industry. Early stage VC deal activity showed signs of rebounding in Q3 with 9.2 billion raised across 657 deals, bringing the year-to-date total to 2,722. And at its current pace, 2020 is tracking to fall short of last year's early stage activity by about 20 to 25%. But of course, it's unsurprising given the stress caused by the pandemic and the fact that both 2018 and 19 were record years. So that's where we see the big slowdown is in early stage. But in Q3, we saw signs of recovery with deal value and deal count exceeding Q2. Larger check sizes continue to dominate the early stage in Q3. The year-to-date total of checks over 25 million currently sits at record high of 15.4%, with the percentage increasing to 18.2% when considering only Q3 deals. So again, bigger deals happening and larger check sizes. Valuation averages and medians have steadily climbed, and fun fact, 19 of the 25 largest early stage VC deals in Q3 were in healthcare. That's not a big surprise at all. So late stage deals have been increasingly resilient through the pandemic. 662 deals with an aggregate value of 26.6 billion closed during the third quarter, bringing the yearly total to 78.2 billion. The consistently high volume of VC mega deals is the real source driving the aggregate deal value and have brought average deal sizes to new heights. So that's where you see the numbers.
Does that include 500 million from Neuro that happened like last week?
Probably not, yeah, because that'll be Q4 already. Yeah, it's definitely a big jump. And yeah, it's the capital markets and the VC markets seem to be kind of blending almost at these late stages. And in tandem with deal sizes, valuations at the late stage continue to climb relative to 2019. The median and average pre-money valuations now sit at 90 million and 672.3 million, respectively. There's a record number of VC mega deals and an ever larger proportion of capital going to deals over 25 million. The valuation growth demonstrates more of a flight to quality rather than increase in the rate of late stage valuation creation. So we might see a kind of a late stage bubble is what that means, essentially. Now, for all the hype that companies are leaving Silicon Valley and all these blog posts that some people are writing, we've seen only a 1.3% drop in share of deal count and a 2.6% increase in share of total capital, to a tune of almost 55% of all US venture capital is going to the West Coast. There were also slight drops in share of deal counts in Mid-Atlantic, Midwest, and Mountain regions, slight increase in South and Southeast, and New England was flat while increasing its total value share the most. So we'll see how this goes in Q4 and into 2021, but the message is clear. No matter where people may be working temporarily or the blog posts about people moving to Austin, there's not been a dramatic shift in the center of gravity of venture capital. It still remains Silicon Valley for the foreseeable future. Now, the global venture industry took a bit of a dive in Q2, but has largely recovered in Q3, and Europe set all-time records left and right this year. It seems most have remembered the lessons of the past, that the best companies are founded and funded during these crisis periods. And valuations overall have consistently climbed as well, as you see here for seed, Series A, Series B, kind of early stage. Big jumps there, and even more dramatic when we're talking about later stage Series C and D+ type of valuations. So again, this is kind of a flight to quality and maybe a bit of a late stage bubble forming. So we'll keep an eye on that. Now, with that, looking ahead to 2021, what can we expect? So 500 startups surveyed 160 investors in April, and then again at the end of Q3. Survey participants were primarily VCs, about 46%, about 30% angel, about 12.5% CVC, corporate venture, 7.5% family office, and just 2% institutional. So key takeaways since the first survey in April, where there was a lot of fear in the market, slightly fewer investors feel the impact. So 66.3%, or 2/3 of the response, said that the coronavirus health crisis has had an impact on their investment, while 83.5% said it in April. So a little bit of well, actually a big reduction in fear, let's say, in the early stage. Also in the survey, 75% of corporate ventures reported they're investing less, and only 20% that said that they have kept the same level of investing prior to the pandemic, which is not surprising. Corporate venture, most of the corporate venture invest from the balance sheet of their companies, and of course they had to hit the brakes and watch their budgets. So most of them did exactly that. 2021 will see fewer pre-seed investments. Over half of the respondents currently invest in pre-seed stages, but only 18% said they plan to invest in this stage next year. That's a big drop. Industries to attract more investments. Mental health, investors' interest is predicted to rise from 10% to 20+% next year. Logistics, investors' interest is predicted to increase from 25% this year to 43% next year. And productivity software will go from 28% this year to 48%, or almost half of the investors next year. So these are kind of the hot topics where investors are looking for next year, given the new environment that we live in. Healthcare, business productivity, and fintech startups have dominated the unicorn class of 2020, as an exponential rise in demand for services in these sectors during the pandemic has changed VC investing trends. Fintech and business productivity software startups account for more than 1/3 of this year's unicorn total. And according to PitchBook, since January, over 70 companies in the US have reached valuation of $1 billion or more, while a total of 79 were minted in all of 2019. So there are some interesting shifts in industries, focused notably, again, mental health, logistics, and productivity software. And over the past decade, the private equity industry has made an aggressive push into late stage deals that were once solely carried out by venture capital firms. This underscores the PE industry's insatiable appetite for tech. And private equity's annual investment in US venture capital deals grew more than 6-fold from 2010 to 2019. And the average value of these transactions has only gone up this year. According to PitchBook, as of the end of April, which was beginning of the pandemic, PE firms have participated in over 800 US VC transactions worth a combined 50+ billion, making 2020 a record year already. The average size of those venture rounds was 60 million, also an all-time high. And because of the abundant capital, VC-backed companies have been staying private longer before conducting an IPO or finding another exit path. This has led to an overall increase in the number of companies seeking to raise late-stage funding. Deals that can be closely resemble growth stage financing with many PE firms are already more familiar. So the second half of this year has now shifted us to more exits via IPO, SPAC, and return of M&A. And we'll see how these trends continue into 2021. So as you see by the numbers, and I kind of went through this very quickly, but you'll have a recording in the slides to look at it in more detail after. You see by the numbers that the long-term trend hasn't changed. Much of the capital and talent is still centered around Silicon Valley. And depending on your company and when travel returns to normal, you will likely maximize in the same place, that we've done this since the 1950s. So that said, it is increasingly easy to create great tech companies in other parts of the world. There's just one Mount Olympus. And as far as how you go about doing that, I wrote an article a couple of years ago that became quite popular. And the link is on your screen, golomb.net/foreign-founder. And with that, I will hand the microphone over to Louis to tell you about the strategy and tactics you have to go through to get ready for the eventual move.
Hey, thanks, Vitaly. And we're going to go from 30,000 feet up in the air down to the ground. I want to respond a little bit to some of those statistics that I saw. I have never seen a time where more people have not been more empowered to, and the context didn't require, just a complete rethinking of business models. And I think we've engaged at L2 Counsel with 30 new startups since the pandemic started. And I think that's a record for me in terms of engagement with new startups. Vitaly so I think that while there might have been a dip in financings, I think another statistic that we law firm lawyers track are the number of new formations that we do, because obviously that's the pipeline for that's the canary in the coal mine for 3, 6, and 9 months out. So while we may have seen some dip in deals, I think we've seen some amazing new companies get formed and get born. So to all of you out there, throughout the world who are tuning in with us, thanks for joining. And I'm on slide 26, Vitaly, which is setting up in the US. And you might think, how is it that I come into the US, and what are my choices, and what are the models that have worked? And I think that the government of Israel, the government of France, and several of other countries have really tried to adopt a model where you create a U.S. holding company, you move your CEO and maybe another co-founder here to the U.S. To run your new U.S. holding company. You place that U.S. holding company at the top of your structure. That company raises money. It attracts new customers, and it tries to build the sales and marketing function, but it keeps the research and development back in the home country, keeps jobs in the home country, and succeeds in using Silicon Valley as a beachhead to bring their technology to the global stage. So I think that's a really tried and true, tested method. But those are not your only choices. You can go direct. You can set up a branch. You can set up a subsidiary rather than a parent, and obviously you can accomplish the flip. Flipping to the next slide, slide 27, Vitaly, if you're driving, some of these questions are driven around: are you going to try and access U.S. venture capital? I think historically, the thought was that U.S. venture firms would not be willing to invest in a company that remained organized and governed by the law of another country. Indeed, venture firms wouldn't even finance companies organized under a different state than Delaware, or in some small cases, California. Very particular that it must be a Delaware company. I think that's really evolved and changed over the last 10 years as we've seen the Silicon Valley phenomenon go global. And we see a lot of U.S. venture firms setting up mini funds in Asia to attack and take advantage of the technologies being developed in certain sub-markets. We've seen that in Europe as well. But what I always say is, are you really ready for venture capital? And that's a big question. Unless you've got $1 million a month of recurring revenues, I would say that you ought to focus on building your product and going after your local sources of venture capital, whatever they might be, government, regional, large company, corporate, and obviously banking and venture sources of capital in your country. I wanted to spend a word on slide 28 about setting up a U.S. subsidiary. This is a very simple process in the state of Delaware, and frankly in any state of the United States. We can do it in a matter of hours. We don't have any capital requirements. We don't have any residency requirements. And so while there's been much scandal about the Panama Papers and special offshore jurisdictions all over the world, in fact, there's no easier place than Delaware to set up and without making a lot of footprint. So here, these on this slide are some of the things that it entails, and again, it's real simple. If you want to set up a new U.S. parent, sometimes that can be done also, very quickly in what we call a flip transaction, where you drop down a new subsidiary, and then you have that new subsidiary offer to exchange its shares with the shareholders of the home country, issuing those shares, those new Delaware shares, to the shareholders in the home country, and the home country shareholders get the Delaware shares. And then you offer new Delaware shares to your angel and venture and other investors here in the U.S. Typically, you would keep all of your activities in your home country, other than your CEO and maybe some senior sales staff that you would move to the U.S. to help go after customers. So that's kind of the typical model of a flip. Moving to slide 30, you know, there are some special issues for flips from each of the world's major jurisdictions. You know, Western Europe, Israel, Australia, Canada, where we see a lot of them, and where we execute on the flip. Going to slide 31 here, I've tried to give you a little visual of how this works. And moving to slide 32, the various intercompany agreements that we would also put in place between the home country and the U.S. office or the U.S. sub to make sure that you're complying with tax transfer rules and that you're able to recognize revenue for what you're doing. Finally, in slide 33, you'll see a different model where you're using the U.S. as a distributor. In slide 34, we have a different model where the U.S. licenses IP from the home country parent. So that's another model that we do often with IP-driven companies, life science companies, where there's an IP license from a university in a foreign country. Slide 35, Vitaly, is showing how we accomplish where the U.S. buys the IP from the home country parent, and there we do a swap of IP in exchange for shares. So the short story is that there are many different types of ways that you can attack the U.S. market, and in many ways that we can solve the specific issues that come from the jurisdiction where you're starting from. I'm moving to slide 37, if we could, Vitaly, and I'm trying to go quickly here, but tell me if my pace is too slow or too fast. But you know, one of the other things that we want to tell our audience today is what are the different types of entities that we use to create startups here in the U.S. and why does it matter? And you'll hear in the jargon that a Delaware C corporation is probably the way to go if you intend on raising money from U.S. investors. And a C corporation, if you saw it drawn on a page, is a box. It's a square box, and what it does is it encapsulates the liability of doing business into a limited fashion, so that no individual has personal liability, and it is a person for U.S. tax purposes, and so it's taxed at itself, and then when it distributes out money to the shareholders are then taxed a second time. So while it's an inefficient vehicle for tax purposes, it's important to use a Delaware C corporation when you're raising money, because your investors are not going to want to receive a tax return every year whereby they would have to declare the phantom income or the phantom loss as you burn money in the early years on their own tax returns. They want to see that the C corporation blocks all the tax responsibilities at the C corporation level. So that's why that's the most frequently used vehicle for raising money and for venture-backed startups. An S corporation is a variety of the C corporation, except that it does not block for tax purposes. Same with an LLC, a limited liability company. It does not block for tax purposes. It is a pass-through entity, and it would issue what's called a K-1 to its holders, and then those holders would have to declare the income or loss that is written on page 1 of that K-1. An S corporation is typically used for family-owned businesses. It can only be used in a single state, so it is usually a very bad vehicle for doing any kind of venture capital fundraising. We see a lot of LLCs in the U.S. U.S. businesses will start out as an LLC because the founders will want to take the benefit of the tax losses and offset those losses against other gains. or because they want to burn off the loss against the income of a spouse or somebody else in there, or some other revenue stream that they have. And so an LLC is often a preferred vehicle at the startup stage, and then you would flip into a C Corp as and when you were ready to raise capital. So those are a few things about the types of entities. I think I've told you why C Corp. I haven't told you why Delaware, and that's slide 39, Vitaly. And we say Delaware because it is not just because it's the state where our new president-elect is from, but it's because it's the state that over the last 100 years has developed a legislation designed to attract and help businesses run, and it has a judiciary that is intent on retaining Delaware status as the #1 destination for doing business. So they're very sophisticated, pro-business, predictable judges who don't play politics and who really try and ensure that Delaware remains the destination of choice for companies. Now, California Corporations Code, if you're actually setting up your headquarters here in the Silicon Valley, will still apply to that Delaware entity in what we call the long arm statute. And so, while beyond the scope of this call to get into those details, the long arm of the political animal of California is not to be ignored. A few other notes that I wanted to give before we dive into the content.
Wait, there was a question. What about Nevada?
Nevada is an up-and-coming competitor to Delaware as one of those states where it is friendly to do business, but it also has it does not have the same long history of legislation, and it does not have the same judiciary in terms of sophistication and predictability. And so I would say that while it's a perfectly fine business jurisdiction to do business in, it is not as attractive, particularly to venture firms, as is Delaware. But thank you for the question, Eugene. I'm on slide 41, and the other big issues that companies have when they try and come to the U.S. in addition to fundraising is how do you get a visa, and how do you remain employed, and what are the terms of employment? And in the United States, we view employment as at the baseline as something that is at will. And so as long as you have immigration status, you can be employed in any capacity and on terms that are completely free for you to agree with your employer, in this case, your startup. And so it's a very flexible approach to keeping the workforce engaged. Employment contracts are not required, and they're typically not used. Oftentimes, people will want to be what we call independent contractors, so that they can act a little bit like an LLC and deduct their expenses against their income to reduce their taxes. So people like to be independent contractors. The tax code doesn't like that because it avoids the payment of payroll tax. And so that's something that is important for foreign founders to know as they come and access the U.S. market is that they need employment status, and they've got to decide whether they're an employee or a consultant. And then finally, as you begin to look at the market for capital, there's convertible debt and equity, and most recently in the last 5 years, a non-debt and non-equity instrument that we call a SAFE has become the ubiquitous form of financing and raising capital for your new venture. And it's designed to not be debt, so that it doesn't have a due date, and not equity, so that you don't have to put a price on your company. It's something that was founded here in the Silicon Valley, San Francisco Bay Area, and has become the ubiquitous form of startup capital. Vitaly, I think I have talked more than 10 minutes now about legal matters, and so I'm going to stop there and invite people to follow up with questions, but turn this over to you and the panel.
Great, thank you for that. So we went through this lightning speed, and we wanted to leave as much time as possible for our wonderful panelists to actually share their experience of investing and participating in companies that have focused on kind of coming cross-border. I don't think anybody on this call, actually, Lou, I think you're the only one that was born in this country. The rest of us came here one way or another as kids or as adults. So with that, SC, Becky, Eugene, if you can unmute, and I'd like to turn it over to you. So with the first question, Silicon Valley has always been the destination for technology entrepreneurs. How has this changed in 2020, if at all? Whoever wants to jump in.
So I guess I can go. Well, the biggest challenge has been for some of the entrepreneurs, especially with COVID, is getting visas. So because of the COVID situation globally, the U.S. embassies have been closed and not issuing any visas. And the still current administration has put in a lot of effort in stopping immigration, and some of it touched some of the entrepreneurs as well, especially very early stage entrepreneurs, early stage companies. But in terms of there are a lot of perseverance. So people in the beginning of the year, a lot of companies we see the founders moved to the US and moved their companies here. So it's been a fairly decent amount of companies. And I think Vitaly, you would probably agree on that as well.
Yeah, absolutely. It's been definitely less than usual, I would say. Becky, SC, do you have any comments on that one?
So we typically invest a little bit later stage, and for all the great reasons Louis mentioned, we invest once a company is Delaware C Corp. So what we've seen is that the companies we look at, they already have at least a small team, like an executive and a couple of people in the US and mainly in Silicon Valley, because that's where a lot of the talent still is. And then they have, operations, engineering in a location where the talent is more cost effective, more loyal, whether that's in, like secondary tech hubs in the US or outside of the US. So the change we've seen since COVID is really in the way we do due diligence, because obviously we're not able to do due diligence in person. And so we've had to develop a number of mechanisms to make up for the fact that we cannot go to the office, get a sense for the culture of the company. We cannot really build a relationship with the CEOs. So that's what we've had to do in adjusting our due diligence.
And SC, this is Louis. Do you feel like this is leveling the playing field for founders outside the U.S. to access the U.S. market? Because to do a Zoom due diligence, you could just as well be in the Ukraine or China as here in the Silicon Valley. I suppose there are time zone issues, but we're all navigating them this morning here, aren't we? Just question for you on whether, in fact, it's faster or easier to get through your due diligence process in the remote world, or whether it's in fact slower.
I will say at first it was harder because we weren't used to it. But now that we're used to it, we actually find that the mechanisms are more transparent. So to your point about leveling the playing field, yes. Does that mean that we will fund companies from anywhere and that, innovation can come from anywhere? I'm with Vitaly. I think that, yes, there is, more innovation across the world. In fact, 95% of jobs are created by small companies, companies that are 5 years or younger. But overall, right, Silicon Valley is still the mecca of innovation. So there's still a very strong preference for, the best companies, the best founders and CEOs having an office, at least in the Bay Area.
Yeah, and I'm just looking at the chat function, and my good friend Jordan Wabb from SV Venture Group is making the point that COVID doesn't level the playing field in terms of network, because it's very hard to create a new network. in times of COVID. You certainly can access the one you already have, but creating a new one, I receive dozens of LinkedIn invites a day, and while I may accept them, I'm not going to go do a Zoom call with somebody that didn't find a way to get a warm introduction to me through someone I know, and that's I guess the real benefit to being here. Vitaly said something really interesting, and that's that I'm the only person on this call who was born here in the U.S. I'll point out, though, that my father was a foreign tech founder from France, and so absolutely the fruit of the Silicon Valley I am in the immigrant story. But do you feel like Silicon Valley represents the values today that it did however many years ago that each of you came? And since you all look like you're teenagers, I'll say that was yesterday, but do you feel like Silicon Valley and San Francisco today has the values that it did when you came to this country? And maybe Eugene, I'll start with you to put you on the hot seat.
Oof. I would say that it's a lot more tech-centric. Like when I moved here as a kid, it wasn't like you go to a coffee shop, you can hear not just tech talk. Now it's like you go to any coffee shop, everybody is just discussing either what's happening in their company, or a new startup that somebody is starting, or somebody is looking for some new talent, or somebody is pitching another VC. So it became a lot more tech centric, and it actually feels a little bit like a bubble here where, the tech industry is here, but when you go like 100 miles from here, you're living this world where the only thing that people care about is tech.
Yeah. Becky, how about for you? Do you feel like this country still represents the values that attracted you? And I don't mean this country, I mean the Silicon Valley. Are we still there?
Yeah, it's very funny you mentioned that. I think to the point Eugene made earlier, when I came here about more than 20 years ago, also in San Francisco, was the first tech bubble. And then that time I thought it was like the epitome of the tech. And now it's even more than that, 100 times more than that. I think it's a lot more tech here, and a focus on technology here for sure. I also noticed the change where the spanning out of the sort of the center. If you think that Silicon Valley will be the gravity center in the past, of pulling talent and technology come in, and at the same time also expanding with probably the internet, because 20 years ago even the PayPal's and Yahoo's already started to have tech hubs in India. So the access to talent to complement to sort of the pools of innovation and people and concentration of that, it seems to be the theme playing out more so than today. So my company, for example, I'm the only one here in Silicon Valley, and a couple of the team members in US, and I have a team in Europe. So in the past, it was like everyone here, right? So 20 years ago was you have a tech startup, everyone here. But now, with the technology access and a lot of framework from a legal and just the PEO type of support globally, that really enable the cost structure that we have today.
I actually agree on that. Like about 70% of our portfolio companies have tech talent outside of US, maybe 60%, but the founders and marketing, product, and sales is here.
Right.
Yeah, it's when my family came over in 1990, Silicon Valley still was making silicon. So my father was on the.
Still are, Vitaly. They still are.
Yeah, kind of. My father was in the semiconductor industry, but kind of through the 90s that went away, and everything became internet focused in the late 90s. So it's quite interesting.
Where I see the possibility of a competitor to Silicon Valley is in China. Honestly, nowhere else. But in China, I've had the opportunity to go to a couple of regions and talk and see the innovation scene there, and the scale at which this is done is so completely mind-blowing that it really has a shot at competing with Silicon Valley, because you have the universities, the governments, and the financial, like the lenders and the money folks, completely working together for a really long-term strategy, right? So in one region, they're creating 11 accelerators. They have mechanisms to fund them. They give them grants, and it's completely orchestrated between these three entities. And so entrepreneurs are more able to overcome the more risk-averse culture that you see anywhere else outside of Silicon Valley, because there is so much of the ecosystem that's provided. It's really impressive.
Yeah, China, in fact, eclipsed US in venture capital totals in 2018, but then some of the incentives were removed and it fell by 50% in 2019. I'm very curious about the numbers when they come out for this year, what direction that's all going, because it's going to be telling. But the amount of talent and the speed and the work ethic is absolutely incredible.
Yeah, I mean, government does a lot of the support for them and gives them a lot of the money. I mean, most of the money is coming from the government related funds.
One way or another, right? Either to the funds or directly to the companies.
Yeah, I think that, sorry.
Yeah, go ahead.
I totally to the point that Asi mentioned, I think the ecosystem is the key, and it's hard to start an ecosystem. But once you start, you have elements coming in, the entrepreneurs, the innovation talent, and then the fund, and then also the customers, right? A lot of things that we build has to go to customers. Sometimes people come to US because you primarily sell to the US market, you sell to the US businesses. You have to be here to know how they work, what they want. Now you start to have an ecosystem also as a customer, for example, in China, the market that big, that really putting things together. I totally think that's.
But it is extremely difficult to do business in China.
Other than the local talent.
Yeah, exactly.
Yeah,
So
for
like,
anybody else.
for
One
a
thing,
company,
because
the
I see a
Chinese
lot of
companies have been fairly good
Go ahead,
entering
Eugene.
the US market. Like Tencent entered the US. We have a bunch of companies that entered the US market from China, but success of companies entering into China has been so-so.
Yeah, it is very difficult. I mean, back in the days, and PayPal, eBay, Yahoo, all of them all of us spend a lot of time and energy just learning a completely different culture. And also the market wasn't the same as it is today. I think that timing as well. But I think cross market is always a lot of learning curve, that your network ecosystem does not naturally come with you when you go into that market. Yeah, I agree.
Becky, what would you tell your younger self? What was the one or two things that you wish you could have gotten to faster or understood faster that you wish you would have known that you could share with our audience today?
Very good question. I came here pretty late. I was like a fully grown, hardly speaking English, right? So then it was a very large adjustment. Once I get to the point out of working in the companies, I run into the problems I had it today. So I could not manage product, could not prioritize, I could not get all the teams work together very well. I should have taken the risk. I should have just go do it instead of, didn't feel like I could, didn't feel I have the network, didn't feel I have the access I needed to start a company. So I waited too long. I should have started a lot earlier and should just go find the network and then start building on what I had.
Well, thanks for sharing that, Becky. How about you, Eugene or SC? Is that any notes to share about what you wish you would have known at the outset before you started your journey?
So I like Becky's comment, right? You're ready. Like, what are you waiting for? Go for it. But I will also say the first few years in Silicon Valley for most people are a little bit like paradise. Like, you're in this place where it's always perfect weather and people tell you you can do anything. And, there's this sort of illusion of ease. But I think becoming successful in Silicon Valley is actually just as hard as anywhere else. And you have to really excel, really push, and you have to have a really deep network. And so maybe, you know, an advice to some of the folks who are on this call is live the dream, and that's part of the experience, but also understand that if you want to be really successful, it's a really long-term investment you're making, and it's a very, very competitive place.
Eugene?
It's a wrong sense of kind of feeling of success when you get here, when you see left and right all these startups raising capital and so on. But for every startup that raises capital, there's many more that actually fail. But at the same time, what we've seen, at least from the immigrant community, they work very hard, and the resilience that they have is very strong. So the success of the immigrant founders is higher, at least from our view.
That's really helpful.
Yeah, why don't we, I think we've kind of organically covered most of the areas that I wanted to touch on. I'll ask one kind of last question that's a little bit leading, and then Louis, maybe you can start taking a look at some of the questions from the audience. If we have some, it's harder for me with projecting on screen at the same time, and we can dive into that. So last question I would ask you before we dive into our viewer questions is, why do you think immigrants are so over-indexed in successful tech companies in Silicon Valley especially? So Eugene, maybe you can kick us off.
Yeah, so partly is because Silicon Valley consists of a lot of immigrants. So that's the big part. I mean, there's lots of immigrants that came to Silicon Valley, specifically into tech from the 90s to now. And that's, I think, one reason. The second reason is they're already going through the first filter of actually getting here. So you already have a small percentage of highly successful people that were able to immigrate into the US. And then from there, you basically, these people go and get very good education, whether here or somewhere else, but they work very hard to prove everybody that they can do it and they can be successful. And I think that's partly this drive to succeed is partly the reason, in my opinion.
Becky, maybe over to you.
Yeah, I definitely think that's totally true, where immigrants are self-selected group. They're risk takers, they're more driven, and, you know, come here. I also feel that, you know, diversity actually makes a huge difference, because you have people with a different background, all smart and driven, and different ideas, different perspectives, so that the one idea can spark more, so that it creates a little bit different thinking, if we want. We create something like, you know, that new frontier, so to speak, on the intellect perspective. So I think these two add up together, smart people, different background, you bounce the idea, the concentration would drive more of the success personally in the company.
Very good. And Nessie, do you want to round us out?
So I agree with what was said. Maybe one sort of other angle to look at it. What I've seen outside of Silicon Valley is a lot of push for more innovation through the creation of accelerators and things like that. And joining these accelerators when there isn't around you an ecosystem to actually push your company way far beyond these accelerators is a trap. And the reason is, if you go through an accelerator and then you're not able to get more customers, get more funding, hire people who are willing to take the risk, then you're actually stuck with a business that has been diluted by the accelerator, cannot grow, and so you're in a bit of a zombie phase. So it becomes a lifestyle that you're never going to be really successful. You're never going to really fail. But if you really want to push your company, that's not a good path to take. So just maybe a cautionary tale. It might be better to be an immigrant than to be in a kind of in an accelerator lifestyle in a place where there isn't a path for you to be successful.
Yeah, that's really insightful. I've seen a number of companies in Europe where the cost of living, especially like Central Eastern Europe, cost of living is very low. They'll go accelerator to accelerator, collect the nickels and dimes, and kind of live off of that and survive for a number of years without really making progress. But they can never get that time back. So thanks for that. Louis, maybe we can jump, we have a few minutes, so we can jump over.
Question for SC and Eugene especially, who are investors. What do you see as the best timing for successful businesses outside the United States to come into the US market?
The sooner the better. The question I get all the time is, oh, as soon as I get funding, I'll move. And that's not how it works. Exactly. You have to be all in. You have to make the commitment. And by the commitment, I don't mean like, oh, I'm like 1 week here, 1 week there. I mean, you relocate your family, you know, have a house, you take your kids to school, like you immigrate, and then you're all in. Because if you think about it, if you're not all into your business, why would I or anyone here in this panel, you know, take a risk on you because you're not all in, right? So why would we be all in with you? And so that's often what I tell founders. You have to be all in, and the sooner you do that, the more successful your chances are at building your network, raising money. The sooner you're going to be ready, to Becky's point.
Great points. Eugene, anything to add? Becky?
This is like almost words taken out of my mouth because we see a lot of, first of all, we see a lot of companies already Delaware registered that are located in different parts of the world. Like, so we are kind of a US company. Would you guys invest into us? So we're in Delaware. I'm like, where are you guys? Like, oh, we're in Ukraine, Russia, or in London or somewhere else. I'm like, guys, like, our fund specifically focuses on immigrant founders, and you have to be here. Not like on a B1 visa, which is a business visa, but like actually here. It's also showing like a skin in the game that you're willing to risk your cushy lifestyle in those countries and actually move here, take a risk to make your company successful. And when is a good time to move? I think when your product is almost ready to hit the market. And so at least have some product, because I think you spending time with your engineering and product team before you raise capital is probably a great idea. It's a lot harder nowadays to raise capital on just an idea. Like, we want to see a product and at least a little bit of proof of market fit.
Well said. I often get that feedback, Eugene, for startups that I submit to investors is, you know, and I feel like the bar to at least venture capital has really risen in the last 5 years, where it used to be early stage and seed capital, and now it's really scaling and growth capital. And if you want real seed capital, that market has moved downstream to angel groups and micro seed VCs. And really friends, family, and high net worth folks. Becky, any thoughts from you as to when is the best time to come to the US?
I totally agree with Eugene earlier on that. Even though it's the sooner the better, there's a balance in, you know, how much time you start with your team, form your initial engineering team, and get the product started. And as soon as you can leave, you should be here, because take time to build network. Take time to talk to customers. So, you know, maybe not day one, but definitely not, you know, years later.
And I think I heard from our earlier discussion that the number one reasons to move here are because of, 1, the network, 2, the deep source of talent, and 3, the customers. Are there any other reasons to move here or to not move here? And, you know, one of the questions that we have is, what is the best method of flipping or accessing the US market? Do you need to do a flip? In other words, I think you've said you need to move here, but does that mean your corporate vehicle needs to be a Delaware C Corp, or can you still be a Ukrainian or Hong Kong entity or whatever entity of whatever country you're in. Eugene, SC, do you want to give the investor perspective?
All right, I guess I'll start. So we invest into many companies where just the founders are here.
Mm-hmm.
And we have one portfolio company that actually moved their HQ from the US to Germany.
Mm-hmm.
For some of the legal reasons that US has on privacy laws. And but generally, we tend to invest specifically into the US-based companies where the entity is in the US, the main entity is in the US.
So the preference for US entities. Okay.
Yeah,
how about you, SC?
Or Canada.
Okay.
So one thing that you really want to keep in mind is when you first move here, how are you going to build your network? And working with someone like Louis, who's incredibly connected, will open doors for you faster than you going to 5 events a week. And so my 2 cents, it's not a must-have for us. We only invest in Delaware C Corp, so it's pretty simple. But my recommendation for you is the sooner you make connections with great law firms and very well-connected lawyers, and the sooner you get to tap into their network, the faster you'll be connected. So that transition, I'd say, make it happen faster. If you're going to do it, why are you going to wait anyways?
Becky, do you think that it matters as an entrepreneur what jurisdiction of your company remains? And do you think you need to have all your talent here, or can they be in other parts of the world? Do you believe in the distributed model, or no?
I also from a corporate legal perspective, I think having a Delaware just make everything easier for us. It's like we're not gonna focus time on things doesn't really add value. If we can set up Delaware, be done with it, that's what we will do. But from a competitive access to talent perspective, it is not negotiable in these days just to have all the engineers in here in Silicon Valley. We know how expensive everything is. So I think that the balance is to say, what is absolutely necessary, and then what is the most give us competitive advantage in terms of access to talent and then the cost. So the trade-off we have to make. In our case, we have the corporate here, and we have a Delaware entity, we just get it done with, and then we have other entities in terms of the contract service entity in other countries to complement the structure.
Thank
Maybe
you.
one last question as we wrap up. As we're a little over the hour now.
Last question. This is a fun one from Alvaro Pena in Bogota. For those of us in Latin America, there's a lot of talk about Miami becoming the Silicon Valley of Latin America. Is it true? Vitaly and I have had many debates about global markets and where real tech hubs are being developed. I'm going to let you take this one, Vitaly.
Sure.
Miami,
it's
a tech hub.
Yeah, I can't claim this one, but somebody called Miami the capital of South America or Latin America. Certainly for businesses, especially multinationals, they're headquartered in Miami. Oftentimes, you have a huge Spanish-speaking population with a lot of business experience from all over the world, not just South Central America. You have a lot of Europeans as well. And that may be true. For example, 500 Startups started a hub there. They tried an accelerator in Mexico years ago, and then they've eventually settled in Miami to be kind of more central. I think from that perspective, from cultural perspective and market access perspective, that certainly makes sense. But you're not going to find certainly as much technical talent. And I think where one of the things that I've done several years ago, looking at kind of at the AI era, and which countries or which regions can succeed. None of the top 100 technical universities are in South America. That's a big problem for the region because you really need those graduates and deep technical knowledge, particularly in this segment. So it's a little bit cautionary. So depending on what you're working on, if you're working on e-commerce or certain things like that, where it's more of kind of applying known business models, certainly Miami is probably a good place. But if you're working on deep tech, Silicon Valley is certainly number one. AI, particularly the Montreal area has become, or Montreal and Toronto and Waterloo areas, because of the universities, have become very deep in AI talent. So you're seeing these things pop up here and there. So that's probably
UK has been growing as well in that space.
Yeah, UK has a number of top universities. So I mean, if we can just follow the education quality, China, Singapore, Western Europe, US, and Toronto Waterloo corridor seem to be kind of the leads for the next era.
Vitaly, I know we're supposed to wrap, but I've got one really great question from my friend, Professor Martin Hamig in Zurich. And he's asking, what is the best practice to demonstrate product market fit for a novel technology solution? And I think it's an apropos question, because I think it's no longer the case that you can roll into an investor meeting and show a great product. People want to see it demonstrated, proof that there is a market and that it fits with your product. And so what is the best way to demonstrate that, especially in times of COVID when we're all remote? SC?
Yes, show me a sales pipeline. I'm not going to be evaluating your product if I may not be in your target market, but if you're telling me I have product market fit, you're telling me I have found people who are willing to pay money for what I've built. Well, show me the money. Like that's the best way.
What a perfect ending for a great webinar. Show me the money, Vitaly. I think you should wrap with some music on top of that. I just wanted to thank all of our panelists for joining today. What a great topic. And I invite all of you to follow up. We will circulate the slides and we'll circulate a recording of this video all by email. And I certainly can be found on the internet at L2Counsel.com, and don't hesitate to reach out. Thanks, everybody.
Thank you.
Yeah, thanks. Thank you for a wonderful panel. I see Eugene, Becky, and thanks again to our teams at Drakestar and L2 Counsel for pulling the data together and helping organize. Thank you, everybody, for watching along. We hope to see you on the next one. We hope you find value. And if you have additional questions, anything we missed, there are plenty of questions we didn't get to, please reach out to us and find us in various places. Thank you again. Have a great day and evening.